The government just revised down job creation by hundreds of thousands of jobs that never existed. Meanwhile, markets are flirting with all-time highs while unemployment quietly creeps higher month after month, the yield curve finally uninverted. After years of screaming recession warnings at anyone who would listen, corporate earnings are disappointing across multiple sectors, and somehow, despite all of this, we're still not in an official recession. How is that even possible? There are exactly 3 economic indicators still holding the line. 3 lonely metrics standing between the narrative of a soft landing and an official recession declaration, and all 3 are hanging by an absolute thread. What's up, guys? It's Tom here. If you've been following this channel for any length of time, you know we've been ahead of this economic shift for months, while mainstream media kept pushing the everything is fine narrative. We called the Bitcoin crash back in December before it dropped significantly. We flagged the massive jobs overcount before the BLS was forced to admit they'd been inflating numbers for over a year. We warned about the manufacturing contraction before it became undeniable, and while everyone's still debating whether we're in a recession, heading toward a recession, or magically avoiding one entirely, the economic model I track shows most core indicators already in warning territory. The recession risk score just hit 67 out of 100. That puts us firmly in what I call the pre-recession phase. And that's up significantly just this week, as market fear spiked hard across multiple asset classes. But here's what absolutely nobody in the mainstream financial media is talking about. An official recession isn't just consecutive quarters of negative GDP growth. That's a persistent myth that even smart people believe. The National Bureau of Economic Research, the NBER, the actual people who officially declare recessions in the United States, they don't use that simple rule at all. They look at a complex mix of indicators across employment, production, income, and sales. Real GDP, real personal income, employment, industrial production, wholesale retail sales, and monthly GDP estimates. And right now, as I'm recording this, we're failing most of them. Manufacturing has been contracting for months. Private sector job creation has essentially stalled out. Real personal income growth is anemic when adjusted for inflation. Unemployment is creeping steadily higher. Wholesale and retail sales are showing clear weakness. But not all indicators are failing, not yet. 3 key metrics are still technically green, still healthy enough on paper, still keeping us out of official recession territory according to the NBR's methodology. The yield curve situation has actually improved. Average weekly hours worked are still above the critical threshold, and bond market confidence in Fed policy remains intact. These 3 indicators represent the last line of defense between the current narrative and economic reality, and I think we need to have a serious conversation about what happens when they inevitably break. So let me break down exactly where we stand right now using the comprehensive model I've been tracking. This isn't some theoretical framework. This tracks the actual metrics that matter for real economic activity. Most of these indicators are already elevated and in warning territory. The labor market is falling apart in slow motion. We're barely creating any meaningful private sector jobs month after month. The unemployment rate has been trending higher for consecutive months. That's not normal in a healthy economy. Manufacturing has been contracting consistently. The PMI readings signal ongoing contraction. Credit spreads are widening as lenders get more cautious about who they're willing to lend to. Consumer sentiment is in the absolute basement. People are genuinely worried about their financial future and pulling back on discretionary spending accordingly. Small business optimism is cratering. These aren't lagging indicators. These are real-time measures of economic stress. But 3 indicators are still showing green, still healthy enough to technically keep us out of recession territory. The first and most important is the yield curve. For years, short-term interest rates were higher than long-term rates. That's called inversion. And it's predicted every single recession since 1970 without a false signal. But recently, it finally normalized the spread between long and short-term treasury bonds as positive again. That's actually a genuinely good sign. It suggests that the recession risk that was heavily priced into bond markets might be resolving, or at least that investors think the Fed is done being aggressively hawkish. The second critical indicator is average weekly hours worked in the private sector. This is what economists call the canary in the coal mine of employment data. Before companies start laying people off and dealing with severance costs and potential lawsuits, they cut hours. It's cheaper, it's easier, and it's reversible if conditions improve. Right now, Americans are still working just over 41 hours per week on average in the private sector. The recession threshold is typically around 47 hours, so we're barely above the danger zone, but we are still above it. Any drop below that level historically signals that layoffs are months away. Companies telegraph their intentions through hour cuts before they make the harder decision to actually fire people. The third pillar is what I call bond vigilante confidence, though that's not the technical term. Essentially, financial markets still trust that the Federal Reserve has inflation under control and knows what they're doing. There's no panic about runaway inflation. Long-term interest rates aren't spiking uncontrollably. The bond market isn't forcing the Fed's hand by selling off Treasury securities yet. This matters because if bond markets lose confidence in Fed policy, interest rates spike across the entire economy regardless of what the Fed wants to do. These three metrics represent completely different aspects of economic health. The yield curve is about market expectations for future growth and interest rates. Weekly hours are about actual employer behavior and their confidence in future demand. Bond market confidence is about inflation expectations and monetary policy credibility. All three have to stay reasonably healthy to avoid triggering an official recession declaration. And all three are showing various degrees of stress, even though they're still technically in the green zone. So here's how I think this actually plays out over the next year. There are really three distinct scenarios, and I'll give you my probability estimates for each best case scenario, maybe 25% probability. All three of these indicators hold steady or improve. The yield curve stays positive and maybe even steepens as growth expectations improve. Weekly hours worked stay above the danger zone as companies maintain current employment levels. Bond markets stay calm as inflation continues moderating toward the Fed's target. In this scenario, the elevated warning indicators I mentioned earlier start improving over the summer, consumer confidence rebounds, manufacturing starts expanding again, we actually get the soft landing that everyone's been hoping and praying for. The economy avoids recession, stocks rally, and everyone looks back on this as a close call, but ultimately a success story. I'm assigning this a relatively low probability because it requires a lot of things to go right simultaneously. Most likely scenario, about 55% probability. One of these three critical indicators breaks sometime in the next few months, probably by summer. My money's on weekly hours being the first to crack. Companies across multiple sectors are already implementing hiring freezes. Earnings season was rough, with companies talking about cost-cutting and efficiency initiatives. Tech layoffs are accelerating if average weekly hours drop below the danger zone, and I think they will in upcoming employment reports. That's the clear signal that widespread layoffs are months away. Once that happens, unemployment starts climbing faster, consumer spending pulls back more aggressively, and the NBER declares recession within months. Markets price in a significant correction as reality sets in. Worst case scenario may be 20% probability, but catastrophic if it happens. All three indicators break simultaneously or in rapid succession. The yield curve reinverts because the Fed has to hike rates again due to a resurgence in inflation. Weekly hours collapse as companies panic and implement aggressive cost-cutting, and bond vigilantes start selling Treasury securities, forcing long-term rates higher regardless of Fed policy. That's not just a recession, that's stagflation. Rising unemployment combined with rising inflation and interest rates, that scenario would trigger a severe bear market and potentially a financial crisis. And here's a part that directly impacts your personal financial situation. The NBER doesn't declare recessions in real time as they're happening. They wait for months of confirming data, sometimes over a year. The methodology is deliberately conservative because they don't want to falsely declare a recession that doesn't materialize. The 2008 financial crisis recession officially started in late 2007, but the NBER didn't declare it until late 2008, a full year later. By then, unemployment had spiked dramatically, the stock market had crashed, housing prices were in free fall, Lehman Brothers had collapsed. The declaration was confirmation of what everyone already knew and felt, not a warning. The 2001 recession started months before it was declared. The 1990 recession started months before its official declaration. You see the pattern here. So by the time it's official, you've already experienced it. You've already watched your 401k get decimated. You've already seen unemployment spike in your community. You've already felt the economic pain in your daily life. The official declaration is a historical footnote, not actionable information for protecting your wealth. That's exactly why these three remaining indicators matter so much for people who want to stay ahead of this. They're the early warning system when they break, not if, when. Recession is coming, whether it gets officially declared for months or not. The economic reality happens first. The official recognition comes later. So what does this actually mean for your personal financial situation and planning? If you're currently fully invested in index funds or the S&P 500, you're essentially betting that these three indicators hold steady. Maybe they will. But historically, when weekly hours drop below the danger zone or the yield curve reinverts, you're looking at significant stock market corrections. That's what happened in previous recessions. If you're job hunting right now or worried about potential layoffs at your company, the weekly hours number is your canary in the coal mine. This data comes out monthly in the employment report. If it drops below the threshold, companies are cutting before they start firing. That's your signal to accelerate your job search, build up emergency savings, or have serious conversations with your manager about your role security. If you're carrying significant debt, especially variable rate debt like adjustable rate mortgages or credit cards, the bond vigilante scenario is your absolute nightmare. If financial markets lose confidence in the Fed's ability to control inflation, interest rates spike across the board regardless of what the Fed wants to do. Your mortgage payment could reset significantly higher. Your credit card interest rates become even more punishing. This is why I've been advocating for paying down variable rate debt aggressively while rates are still manageable. For retirees or people near retirement, this environment is particularly treacherous. You don't have time to recover from a major market downturn. If these indicators break and we get the likely scenario I outlined, traditional balanced portfolios could see significant drawdowns. At retirement age, you can't just wait it out for years like a younger investor can. Look, I completely get that none of this is easy to hear, especially if you're already feeling squeezed by higher costs of everything and wages that haven't kept pace with inflation. Charts and economic models don't fix the immediate reality of expensive groceries or higher rent. But knowing what's actually happening beneath the surface, and more importantly, what specific metrics to watch for early warnings, that's infinitely better than flying blind and hoping everything works out fine. The model's forward forecast is currently showing the most likely scenario as most probable right now. One of the three critical indicators breaks by summer, recession gets officially declared by fall, markets correct significantly. I remain defensively positioned based on this analysis, heavy cash allocation, reduced equity exposure compared to normal allocations. The rest in treasury bills and short-term bonds, and you know what? This positioning has significantly outperformed a standard balanced portfolio so far this year. I'm not market timing based on emotions or gut feelings. I'm following what the data is actually telling us about economic reality versus the narratives we're being fed. If you want to track this analysis in real time as the data updates, I built a comprehensive dashboard that tracks all the economic indicators I monitor, provides forward forecasts and updates weekly with new data. The next employment report comes out soon. That's when we'll get the next update on average weekly hours worked. If that number drops below the threshold, we're likely looking at the beginning of the end for the soft landing narrative. Bottom line, most core economic indicators are already flashing warning signals. The recession risk score is 67 out of 100, which puts us firmly in pre-recession territory. We're already experiencing economic stress, whether it's officially recognized or not, but three critical metrics are still holding the line between current narratives and economic reality. The yield curve normalization, weekly hours above the danger zone, and bond market confidence in Fed policy. Watch the next jobs report like a hawk. If average weekly hours worked drop below the threshold, that's the canary dying in the coal mine. If the yield curve reinverts, that's markets pricing in significantly more economic pain ahead. And if bond yields spike while stocks sell off simultaneously, that's stagflation knocking on the door. Any one of those three scenarios, and we're not talking about recession risk anymore, we're talking about recession reality, whether it gets officially declared or not, the time for wishful thinking is over. It's time to prepare for what the data is actually telling us is coming.